All right, everybody, welcome to the conclusion of selling weekly lottos. I'm going to do this for the people who are interested in the metrics, in the statistics of what I did. Let me just put the disclaimers up first, always have to. Bozam. All right, the main thing here is this is all an experiment for me. And I'm not a financial advisor. I don't work in investments. I'm just a normal guy that learned about this. And I just tried it out. All right. The most of the video is gonna be directly in the spreadsheets, but I will say just beforehand, last year when I started this, I thought it was gonna be the best thing of all time. And I would have to retract my statement there. It is not the best thing of all time. It is still pretty good, but there are some flaws. All right. The main thing here is you take the whole hit on the way down, but you only get pieces of the up, right? So any retraces will cause you to easily lose all your profits. I had a lot of stocks that retrace, and big retraces too, like 30%, 40%, 50% from their highs, right? Anything like that happens, and this strategy is really going to struggle, okay? So I actually was unable to beat the market as my total portfolio because I had a lot of stocks that had big pullbacks, all right? And in this series, I wasn't able to really display those losses or those like losing my gains and stuff like that, because if the positions weren't directly related to the week, then I didn't include them. I tried to make like a roster thing, but that wasn't a really good way. So part of the reason I'm concluding this series is because I want to show the full picture with my next one. All right, so that was a major flaw in this. I couldn't show what's happening behind the scenes if I'm not using these stocks for my weekly options. And so this is going to be just income related post, income related series. All the income is correct, but the total portfolio value wasn't really displayed correctly by me. All right, so with that being said, I'm going to go ahead and go directly into the spreadsheet. Be careful of your volume because I'm going to be a lot closer to the camera, so my voice might be louder, so you might want to turn it down, okay? All right, everyone, here is the spreadsheet. I hope my voice isn't too loud. I'm trying to speak a little quieter. All right, so this is all of the weeks, all right? So started here, week 1, that was $430 using $120,000 in risk for a 0.35% yield, right, with the Netflix 1220C. All right, I'm not going to go through every single week, but that's pretty much how it was designed. All right, I'll post a little screenshot of all this that has everything in one like frame. All right. But for now, we're just going to go through it, all right? So here we have, I changed up the spreadsheet a little bit. I got the full year, the first half, and the second half, okay? So for the full year, I made $72,047, all right? That's just taking the sum of all the income that I made and adding it, right? In the first half, I made $39,670. In the second half, I made $32,377, right? But in the first half, I risked an average of $132,000 per week, while in the second half, I only risked $57,000 per week, right? $57,500. That's an average of using about a little bit less than $95,000 every week, all right? So as far as total yield, I got 76%. That's basically taking the total income and dividing it by the amount of risk I took every week, and that adds up to 76%. In the first half, that was a 30% yield, when in the second half, that was a 56% yield, because I almost made as much in the second half as the first half, but I used a lot less, right? I used a lot less of my total capital, which increases the total yield, all right? But to be fair about it, I actually had $250,000 available that I set aside for this experiment, and I only got a little bit less than 29% if you take the total income and divide it by the amount available, which is 250,000, right? That leads to 29% return. So I think that's a more fair assessment of my yield, right? And even though I used way more money in the first half than the second half, I did get a higher floor yield just because I made more than the second half. All right. Now we're going to look at the averages. All right. This is just taking the total income and dividing it by the amount of weeks. So on average, I made almost $1,400 per week, right? In the first half, I made more than the second half because I, just made more. That's it, right? But the second half, the average yield was a lot higher because I used a lot less risk, even though I made less, all right? And that in total, my average yield was almost 1.5% per week. We don't need to look at the annualized for the full year because they're just right here, right? But for the annualized for the first half and second half, I had a higher annual dollar amount for the first half, but I had a much higher annualized percentage. That's just taking the average yield times 52 or the average income times 52, right? So it was a lot higher. I personally prefer having just a higher yield, even though you make less, because you have a lot more capital available in case you need to make other moves. All right, these are my fun metrics right here, okay? Profits from profits. This is all it's doing is taking total income, multiplying it by the average yield, right? And that's how much I could be able to make every week from now on using just the income that I've already made. So just the profits that I made. If I take everything out of my account and only use the profits to indiscriminately sell contracts, I could make $1,000 per week. And that might seem a little bit unrealistic, but as far as having 52 data points goes, it is more feasible. I wouldn't mind even just getting half of this every week just by writing contracts on index funds. All right. So salary from profits is just profits from profits by times 52 weeks in a year, right? So that's how much I can expect to make in a year. Now, just keep in mind, these are not industry-wide standards. These are just my fun metrics that I just made up because they are fun for me to look at these numbers, all right? But yeah, almost $55,000 I should be able to make if everything goes well, all right? And then $34 an hour, right? If this was a 40-hour work week, then this is how much I would be making per hour, all right, over the last year. Now, this metric I think is really, really nice because this is the only metric that's weighed against a flat amount of time, right? A flat amount of time. All the other metrics are kind of weighed against each other from collateral and total income and yield and risk, right? But this is the only one that is weighed against a flat amount of time. So it's going to be better to make a higher dollars per hour, right? And then weeks until 2x. This is how many more weeks I'll need to take to basically double my average risk, which makes for what some people call a house money account or a free money account, where basically my total income is going to equal the amount of risk that I take, which means I could take out all the original risk and just use the income that I've made, right? And that's going to take about 16 more weeks, all right? 16 to 17 more weeks. All right, here comes the really important part. Right, the call put ratio overall sold more puts than calls, right? 47 calls and 61 unique puts, right? But in the first half, I sold more calls than puts, but in the second half, I sold much more puts than calls, all right? And the total assignment rate was pretty high for calls. 14 out of my 47 calls were assigned. That's almost 1/3, right? And that's crazy. That's basically the most, I think, telling, the most it really shows that this whole year was a bull market, because most of the time when I sold a covered call, I would sell it 10-20% out of the money. Like, means the stock has to go up 10 to 20% within 5 to 7 days. And they still did it, and they still got my shares, right? And a lot of this income is coming from these call assignments. So this shows right here that this was pretty much a bull market the whole year, almost the whole year, with little bits of neutral market and bear parts from time to time, but mostly a bull, right? It's pretty astonishing to see. I did not expect almost 1/3 of my calls to be assigned. All right, only 5 out of 61 puts were assigned. So that I feel like would be the more like that's what I would have hypothesized to be more like likely to happen. It's just like not that many puts got assigned, right? And then I did let one contract expire worthless out of 90. Out of all the contracts, I either let them assign or I buy to close. This one in particular, I remember it was the take two call. I sold a covered strangle and the put got assigned. So I just let the call expire worthless. That was the one time I let that happen. Otherwise, I mostly buy to close when the contracts get around 80 to 95% profit. And then I move on to the next week. I think that's going to be better, and it also reduces the risk in case the stock does something crazy in the last possible day or two, and so you can capitalize on the next week instead of being at risk for the current week. All right. Little sets of data I took. There was 19 weeks that I was under 1% yield. That's not including the losses. So from 0 to 1%, there was 19 weeks, right? And 13 of the weeks I was above 2% yield. And 11 of those 13 weeks were from calls getting assigned. So again, calls getting assigned, a big part of the strategy. All right. And then 4 weeks of losses from the cash secured puts. Right, that's when I lost cash secured puts because they went down lower than my break-even price. And then 9 weeks of total account value losses where either cash secured puts or covered calls, like the shares fell lower than the premium I received for the options that I sold. All right. So yeah, that's basically it. I'll send it back to the other screen. All right, so there you have it. I'm gonna continue going forward with weeklies, but I'm just gonna use the profits that I made, the income, that $72,000, and I'm just gonna continue with index funds, with Nasdaq or S&P 500, QQQ or SPY, because right now I feel like I've been trying to pick these stocks. Some go up huge, some go down, but it's not totally worth it for me right now to try to pick stocks that will beat the market when the total market funds are doing great. They're just doing really wonderful right now. And I will say this: the approach that I took was a kind of a time in the market approach. Like most of the time, I just always sold a contract just to have it up there. I was putting some pressure on myself to always have a weekly. All right. But I'm going to go towards the timing the market approach instead. I think that's going to lead to better results. So I'm not going to put pressure on myself to always have a contract being sold that week. And when the market dips, try to get the better price. That's what I'm going to be going for from here on forward. And going to figure something else out with the other rest of the portfolio, and hopefully have something to show that shows how the whole portfolio will do with this strategy. All right. Well, hope you enjoyed. All my videos are up. You can always look at them anytime. I have all my posts written on Substack if you want to read the posts. And I hope you learned something. And this has been a fun time. All right. Take care.